continental Europe, where the economy held up better, where the capital market is I think, less significantly engaged with that in North America, has held up a good deal better, with the exception of residential markets in Ireland, Spain, and a number of other places, but those are the principal ones that what I would single out. And so far, there hasn't been very much of a correction, although that's probably coming in the range of 3 to 5% in terms of capital values in this year. That won't have the same flexibility of a rebound as the North America, sort of going forward. Australia also got significantly affected because its listed property trusts were perhaps at the edgier end of the financial structuring that real estate had gone in for around the world. So they were significantly affected. The capital market is global. The consequence is global. The degrees of variation are all simply that. They are degrees around a general theme.
So, Philip, today, do you want to buy outside the U.S.? You had mentioned you're interested in some markets, but are you ready, or are you still just waiting on the sideline?
We are ready to start looking. We're not ready to begin construction, but we are looking in markets overseas where there is capital formation, where we have limited country risk, where there is tenant formation or expansion. And we're also looking in recognition that the world is globalized, and that our traditional tenants also have presence overseas. And we are right now perhaps not as daring as GE in looking at markets in the U.S. With regard to new development just yet. But we've had some invitations by some sovereign funds and so forth to take a look at expanding our presence overseas. And I think that's what's been compelling us. So in the UAE and in Brazil and in the Far East, we are taking some serious looks at expanding our footprint.
said you made a strong bet on the United States. In making that bet, has your spread increased type? So if a year ago was a 6 to 7 today, have those spreads that you demand increased as part of that? Or you think it's business as usual as it was 6 months ago? For a long-term investor, you just continue to make good investments?
There's been no question that our return expectations have gone up and across risk spectrum. And given the decrease in volume year to date, which is down 80% on the big deal side, it's a little difficult to speak at length at where pricing is shaking out, and that's an anomaly that I'm not terribly familiar with. But if you told me you had an opportunity for a Class AA building in a progressive city in the United States that yielded that on an unleveraged basis had a 10% return, that's something that I'm probably going to get excited with. So I'd prefer to kind of characterize it in terms of upward movement. It hasn't been substantial. The without question, when you start taking down the effective leverage and you start becoming a little more conservative with your underwriting standards, that pricing has changed for what the seller's expectations were 12 months ago. I don't believe the larger deal size and on the quality size side that pricing has changed nearly as much as it has on sort of the call it commodity real estate out on the well-located buildings in cities that are faring well.
Very interesting. One